You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Hello, and welcome back to Infinite Banking Mastery. I thought it would be a good idea to do a podcast on important things to remember once you've started your policy. I just had a client, let's call him Mark, because of course that's not his real name, who has had a policy for 5 years. 5 years now? Well, more like 4.5 years. In December, it will be 5 years. Except he won't hit year 5 because he decided to close his account. Now, truly, it just hurts my heart when that happens. It doesn't happen very often, but once in a while, someone will feel they need to close their account because they've gotten into a situation where they feel they have no choice, or they feel they weren't fully wowed by the policy. Always remember that the one thing IBC isn't is a short-term vehicle. If you fund the policy for under 7 years and close it, you will not get all of your dollars back. You will have a loss. It is a long-term vehicle. Nelson Nash always said you need to think long range, and you need to think long range when it comes to your policy for sure. Remember that those first years are the startup years of your system. Since the beginning years are the startup years, you will not have access dollar for dollar to all the funds you send in. Your banking system needs to get off the ground first. It needs to get past the startup time period. This time period can be different for each person depending on your age, health, the structure of your policy, the funding, etc. But it will generally be at least a few years before your policy takes off, before it becomes what we call cash flowing. And then it never looks back. It's amazing. And I think very worth those few short startup cost years. Remember, you are starting a banking system, which thankfully is nothing like starting an actual bank. Because if you were to want to start an actual physical bank, you would have to, 1, choose your charter, or in other words, who regulates you. 2, gather your group of founders, which is usually more than 5 people. Keep in mind that the regulators will definitely scrutinize each one of these people. 3, you will need a detailed business plan with your financial projections, target market analysis, etc. 4, you will need to raise capital, at least 10 to 30 million, and those are funds you cannot touch. Let me say it again, you cannot touch those funds. The regulators will want you to have a large cushion. 5, you will need to file a charter application, pay fees, undergo extensive background checks, then obtain FDIC insurance approval. After you've done all of this, there will be a review period of only 1 to 3 years, where examiners will scrutinize your business plan, capital, management team, etc. You have to wait 1 to 3 years. That's nuts. And approval rates after doing all of that are very low. After you've done all this, it is hard for you to even get approved. And all of that has to be done before you can find a location, get your software in order, hire staff, get your inventory. And then, of course, you will have ongoing regulatory examinations. Whew, no thank you. At least for the majority, they are nowhere near the vicinity of this option. And even if you weren't starting a bank, maybe simply starting a business that you expected to become cash flowing for you. Because, of course, you would expect it to become cash flowing because that's the whole point of starting a business. But it's not going to start off that way. You will have to do all the things necessary to get approved and open a business, and then find your location. And in some cases, you will need to build. Like for me, when I opened my espresso business at the age of 21 and I had no idea what I was doing, I had the location, but the first thing I had to do was get a business license and a health permit before I could get close to building the structure. They wanted to know what was going to be on my menu. before I even knew what was going to be on my menu. I mean, of course, all the normal coffee options for sure, but I decided I wanted to blend drinks as well, such as frappuccinos and shakes to make it more interesting, as that was just starting to happen back then. And that opened a whole nother can of worms. They said, well, if you will be blending here, then you will be classified as a restaurant. Really? Because I don't see a stove or an oven in here. And they said, therefore, since you're a restaurant, you will need a 3-compartment sink, a hand sink, a mop sink, and a bathroom. I was completely dumbfounded, but also determined to blend drinks. So next thing I know, I am hiring a company to dig 15 feet deep into the ground to get pipes set up for the bathroom. I mean, what in the world? Talk about some crazy, silly rules. Once you get past this stage, you will need to get your appliances if your business requires appliances. Software, inventory, hire employees, the list goes on and on. So when we compare that to a simple waiting period on a whole life policy before the policy becomes cash flowing, I'll take it times 2. Or in my case, 9, because that's how many whole life policies I currently have. And I don't just accumulate policies just to accumulate them. I have only added on policies as my income has increased over the years because I needed a place to store that money. Because let me tell you, I wasn't going to store it in the bank and contribute to fractional reserve banking and the whole inflation problem in the US. But there was no more room in my existing policies because if I added premium to my existing policies, they would have become modified endowment contracts and become taxable. So over the years, I have accumulated more than one policy on myself and other family members. Taking over debt to outside banks is another reason you will likely need to grow your banking system over time. But back to my earlier point, the fact that your policy will take a few years to begin cash flowing is very important to remember. And back to my client, Mark, who decided to terminate. We did have discussions about this over the years, but it just seems it was too hard for him to remember or too difficult for him to grasp in the first place. But it's really not that complicated. You are saving money into a life insurance vehicle. Whole life is the best and safest vehicle, and it will take a few years to become cash flowing because there's a cost to the policy. And the cost is the death benefit. But because of the way us IBC practitioners are structuring these policies, the growth of the cash value will tip the scales and cause your account to become cash flowing. And once it does, it will never look back. Like a fine wine, it gets better with age. One other thing you don't want to forget is that when you are borrowing money from the policy, you are not borrowing your own money. You are borrowing the life insurance company's money. Sometimes I talk to people who believe they are borrowing their own money and are paying themselves back. No. And that's one of the things that makes this concept so special, is that you are able to borrow other people's money while your cash value continues to grow. By other people, I mean the life insurance company. So you are taking a loan against the policy, paying the insurance company back, which also builds back up your available balance. And in the meantime, your money gets to keep growing, compounding, uninterrupted, which is a huge win. Having a pool of cash that only grows by the premium dollars you're paying in, by the dividends being paid in, and the interest being earned and not going down, even when you borrow against the policy, that is incredibly powerful. Add in the actions of treating yourself like an honest banker, and it is the most powerful process and way to build wealth that I have ever seen as a financial advisor for over 20 years. Taking over the banking function in your life is the most powerful thing you can do. And of course, you can diversify from there, doing all sorts of things, or run your money through your system and then diversify into other things you're passionate about investing in, investments or real estate or whatever it is. But the actual banking function is the most powerful and should be at the foundation of what you're doing. Because if you owned an actual physical bank, would you take your money to someone else's bank? You'd probably run it through your own bank. And you can do that here too. But people forget all this sometimes or get confused by it. So let me tell you, if we're working together and we haven't discussed this in a while and you begin to feel confused by it, please reach out. Let's get something on the calendar so I can refresh your memory and help to renew your joy in the system you've built. I would say these are two of the biggest things that people forget once they have their system in place. And unfortunately for Mark, he wouldn't give me the chance to help him understand once again. And so just as his policy was becoming cash flowing, he decided to walk away. He had just gone through that startup cost period and the sun was shining on the other end, but he decided to close his eyes and walk away. I mean, it really hurts my heart. Now, I will just add that if you are much older and wanting to start a contract, it may take longer, much longer to become cash flowing, or depending on your health rating, maybe it won't quite get there. But that doesn't mean it's any less valuable. You are still able to borrow against the policy, having access to all or the majority of the dollars you paid in, while maintaining a death benefit. For you, this may be what's the most important. Almost like it gives you permission to spend your dollars while also being able to still leave a legacy to your family if that's important to you. Some have a hard time because they desperately want to leave an inheritance to their children or grandchildren, but life is expensive and those dollars go quickly. Using some of your resources to buy a life policy, become a co-owner of that policy so that you will receive dividends, and then accessing the cash value as needed, knowing you will still be able to leave a legacy, a tax-free legacy to those you love, may be a win-win to you. I can see it. It's a win-win in my book. I don't have to choose or decide, well, I'm just not going to worry about my kids. I'm going to spend all my money while I'm alive. This way, I don't have to choose to leave an inheritance or spend what I need. In my retirement years, I can spend my resources knowing there will be a death benefit left to my kids. And that is awesome to me. And if that sounds awesome to you too, and you would like to partner to build your plan, as always, feel free to reach out. You can reach me at Valerie@alphaomegawealth.com. I hope today's episode was a helpful reminder, and I hope you have a wonderful week. Take care.
This is thepodcastfactory.com.